I think we've seen this movie before. The expectation is that this lasts a few days, but who knows? And where I'm really focused right now, given that the fiscal impact is supposed to be minimal, it's really turning my attention to the labor market in particular. So we know that there will be a furlough of around 40% of federal workers, around 900,000, and a delay in pay for all federal workers. Now, the Trump administration has said that they're looking to make some of that permanent, and that could perhaps create a shock in the job market. And of course, the Fed is very focused on the labor market right now as it considers future policy. And as you mentioned, this also comes at a time where we could have delayed information about employment that we would have received on October 3rd. And so we're just closely monitoring the situation. Now, from a financial market impact, in the past, shutdowns have had a limited effect, on bonds and stocks. But with valuations so stretched in equities today, this time potentially could be different.
How long will markets give it before they start to see a real impact? Because everything's been quite muted at this point, and I'm just wondering how much patience that investors will have before they want to see progress in trying to restore government operations.
It's a great question and probably unknowable, but thinking about the stock market and where things are at from a valuation perspective, you have a PE ratio that is very much above average. Entering the year, it was around 22 times. And when we kind of look at that and we look at history, when you bought into the S&P 500 at that kind of forward PE multiple, your returns for the next 10 years were pretty muted, +2 to -2. And so I just wonder how patient equity market buyers are going to be as the shutdown continues, and maybe they get a little fearful of what the outlook might be for stocks and continue shifting into credit. We've seen such demand for alternatives in credit, as you mentioned, Caroline, to open. And I really think with the contractual nature of credit, we could see more demand from investors in this type of a volatile market environment.
Okay, that's into more demand. That's really interesting because, we have already seen such exponential growth. Part of the appeal of private credit is that it's niche, is that it's nimble, and yet there have been and are starting to be some worries about whether this market is overheated. Do you think it is overheated? It's attracted the ire of regulators in some countries. In Europe, there is concern about the rapid growth of private markets. Your view?
Yeah, you hit on something that is very important. Given the rapid growth, there's more demand really from asset managers that have raised private credit funds, and there is demand from private equity sponsors and borrowers. And so what that means is you need to be very careful about the deals that you're accepting. There's been a degradation in quality in terms of underwriting, but also some of the covenants. And we're also seeing spreads that are compressing pretty significantly. So now is really a time for caution. Now, that said, you're still getting a nice pickup compared to public debt. But, the public markets are seeing demand too. This month alone, high yield bonds have done, 60 billion of issuance. That's twice as much as we would see in a normal month, and that's really hitting a level we haven't seen since 2021. So demand in both public and private markets.
How are you assessing, I suppose, that concern over the quality of assets out there as well? Where are you collecting the information to be sure that you're making the right decisions when investing in private markets?
Well, at Oaktree, we're bottom-up fundamental managers, so we're underwriting a company's credit worthiness, but we also are looking at consumer and sector data to inform those views. And right now what we're seeing is that soft data has recovered from April lows, but hard data such as monthly spending, while it's on trend, there's definitely a bifurcation in the data. So you're seeing that the higher income consumer is still spending, the lower income consumer perhaps is already in a recession. A few things that we're keeping an eye on: we've seen relatively weak data for travel in August, as well as hotel occupancy, which could signal that the higher end consumer, is kind of tapping the brakes a little bit, given so much uncertainty in the market. There's so much happening in the macro backdrop, more than I can remember.